3 stocks I'm watching, the August 2019 edition. Let's get started. What's up everyone, my name is Ale and welcome back to my world of stocks. In case you're new to the channel, let me just quickly explain that this is the monthly series where I try to show you guys a variety of different stocks so that you know what's out there and is available in the market. But these are not stock picks or stock recommendations. I'm not trying to convince you guys to buy or sell anything. I just think that this is a fun way of showing you a variety of different stocks, and if you happen to find any of them interesting, then you can research them further and make any decisions on your own down the road. And there's a number of different ways that I pick these stocks. Like sometimes it's a stock that might be down a lot this month, or it might be a stock that I think has a lot of potential, or maybe it's a stock that I'm actually thinking about investing in myself. But for example, last month we took a look at only Chinese stocks because we're going through the whole kind of trade war. So that gives you just kind of an idea. But if you want to see past episodes of this monthly series, you can find the playlist up here, down in the description, or at the end of this video on a clickable card. And one last thing, I've been trying to think of a way to make this series more fun and entertaining. And one of the suggestions that you guys have been telling me is to switch things up and do like one high risk stock, one medium risk stock, and one low risk stock, and that'll equal the 3 stocks for the month. And I actually think that that's a really fun idea, so we're gonna test it out in this month's video. If you guys like this idea, then let me know by hitting the like button or down in the comment section, and I'll be sure to keep doing it in the future. But with all that said, let's go ahead and start with stock number 1, and this is going to be our high risk stock. And for this one, we're gonna take a look at Albemarle, which is ticker symbol ALB. And this is a company that develops and manufactures different chemicals, usually specialty chemicals, that are then used by other companies to manufacture like electronics and construction materials and even electric vehicles, which is what got me kind of interested in this stock in the first place. See, Albemarle happens to be the leading global supplier of lithium, which is the metal that is used in batteries, so that makes them a very big play on the electric vehicle market. Now, when looking at the stock, it has essentially traded right along with the price of lithium, which pretty much makes this a commodity stock. To be fair, lithium only makes up around 37% of their sales, but it's still enough to drastically influence the stock price. And as you can see here, the price of lithium took off through the end of 2017 as electric vehicles started to become more of a reality. But since then, lithium miners and manufacturers have increased their capacity, causing the price to drop. And that ultimately led to investors flooding into stocks like Albemarle, again through 2017, due to all of the hype around electric vehicles before turning sour on the prospects, causing the stock to plummet and lose almost half of its value, which is also down over 30% from their 52-week high and still down by over 3% so far in 2019, again at a time when many stocks have been performing very well. So again, this is not a stock for the faint of heart, and it's really a long-term play on the growth prospects of lithium, which Albemarle projects that the demand of lithium will increase by a compound annual growth rate of 21% through 2025, with electric vehicles making up the bulk of that demand at around 36% growth. Because of this, they're looking to double their capacity over the next 3 years, which is an enormous feat when you're already the world's biggest supplier. But in the meantime, EV sales still make up only a tiny percentage of the automotive market. For example, the United States is the second largest country when looking at electric vehicle sales, only behind China, yet only 2% of the vehicle sales here are electric. Because of this, Albemarle hasn't really seen much growth yet, as their sales have been relatively stagnant in recent history before finally starting to rally a little over the last couple of years. And while they technically have been profitable from a net income perspective, bringing in almost $700 million last year alone, which is expected to continue growing by 13% this year, 8% next year, and an average of over 14% over the next 5 years, they've still been investing extremely heavy into their lithium expansions, which caused their free cash flow to actually turn negative over the last couple of years, which has worried investors even further. But again, that's short-term spending for the long-term gains that may provide a massive opportunity over the long term. Morgan Stanley predicts that electric vehicles will actually overtake traditional ICE vehicles in the next couple of decades, while Statista estimates that EV sales will grow by a 22% compound annual growth rate through 2025. And there's other projections out there that are much more bullish than this, so there should be plenty of room to the upside if things happen to go a little bit better than we expect. Granted, the biggest market for EVs is still China, and a ton of the lithium is actually sourced in China, so that could pose a few issues with the whole trade war that is going on right now. But over the long term, there's plenty of opportunity here, assuming that Albemarle doesn't make too many mistakes. But while you wait for the future to take shape, you're still getting a dividend yield of about 2% from a dividend champion that has increased that dividend for 25 straight years. And you're paying a much lower price for it than the sector median at less than 12 times forward earnings versus the sector at almost 17, and a forward PEG ratio of 0.8 versus the sector at close to double that amount. Still, I'm already invested in Tesla and NIO, and that gives me a ton of exposure to the electric vehicle market and plenty of risk to go right along with it. So I don't really see too many reasons for me to get involved in Albemarle myself. But if you happen to be looking for an alternative investment strategy to the electric vehicle market without having to go through like Tesla or other vehicle manufacturers, then Albemarle might be a stock worth looking into. And at the very least, I know I'll definitely be tracking it into the future. Okay, and that brings us to stock number 2, and this happens to be a biopharmaceutical company, and one that I've actually had my eye on for a very long time. I know a lot of my viewers are actually invested in them, and for that reason I've been kind of keeping my eye on it. And it's a company that was performing very well, but recently the stock has been taking a really big hit, and that company is of course Gilead Sciences, ticker symbol GILD. And what's funny is that I actually got very close to investing in Gilead, but I was kind of tracking both Gilead and AbbVie at the time, which is another biopharmaceutical stock, and AbbVie happened to take like a huge crash, and that got me like really excited about AbbVie, and they had a really nice dividend too. So I actually ended up investing in AbbVie, and I didn't invest in Gilead. But based off the comments that I received in the AbbVie video, a lot of you were actually saying that Gilead is a better option to AbbVie. So for that reason, let's go ahead and take a look at Gilead, and let's see if there might actually be some opportunity here as again our number 2 kind of medium risk stock. Okay, so when checking out the stock here, you can see that they've had really bad performance over the past 5 years, currently down over 27% during that time. And if you calculate it from their highs back in 2015, then when they were trading for around $119 per share, they are currently down by over 45% from those highs. And more recently, they're still down by about 18% from their 52-week high and are only slightly positive so far this year, at a time when many other stocks are breaking new record highs in an otherwise roaring market. To be fair, their performance is much better if you zoom out to the past decade, but the fact remains that this is a beaten down stock no matter how you slice it. And this poor performance has led to a much more attractive valuation, as they currently trade for less than 10 times non-GAAP earnings, while the sector median is more than double that amount. Of course, there is a reason for this, and we'll take a look at that in just a second, but back in its glory days, Gilead was actually considered a very high growth stock, mostly thanks to major innovations that were further fueled by major acquisitions, as you can see on this page here. This expanded their medicine portfolio to include all sorts of treatments for certain cancers, viruses, inflammatory diseases, and several others. Notably, their treatments for HIV and hepatitis C made them one of the top pharmaceutical companies in the world. This led to surging sales, especially in 2014 and 2015, where they topped over $32 billion in revenue, which was up huge from the $7.9 billion that they posted back in 2010. However, that's mostly where the good news ends. Mostly due to new competition in HIV and hepatitis C treatments, their sales began to plummet in recent years, falling in each of the past 3 straight years, and they're even expected to drop a little more this year in 2019 before finally stabilizing a bit in 2020. Needless to say, this is not a pretty picture that is painted, but on the bright side, a ton of this bad performance is being priced into the stock right now. So if you think that they can turn things around in the future, then this may prove to be a good entry point for the long term. And there are in fact reasons to believe that, notably because they've hired a new CEO who's already began implementing changes to fuel future growth, like making managerial changes and striking new partnership deals, like the one that they just made with a Belgian biotech company called Galapagos that is worth over $5 billion, and the agreement runs for 10 years, giving Gilead the option to increase their ownership of Galapagos to almost 30%. And it also gives them exclusive licensing rights to develop and commercialize all of Galapagos' current and future programs in every single country outside of Europe. So that's a huge deal because it greatly expands Gilead's portfolio. Not to mention that they already have an HIV drug that only did $1.2 billion in sales last year, but is estimated to peak at around $6 to $10 billion in the future, and they're even working on a newer HIV drug that some analysts think could be even bigger than the previous. On top of that, they have several promising drugs that could reach blockbuster status in cell therapy, anti-inflammation, and they're even working on several new ones to treat the worst cases of fatty liver disease, a market that is estimated to reach $35 billion. And it's likely that their pipeline will get even bigger in the future with investments in research and development and future acquisitions that can easily be funded by the nearly $17 billion that they have in cash, with a current ratio of 3.78, and the billions of dollars of positive free cash flow that they continue to generate every single year. Of course, it has been declining significantly, especially in recent years, but if they stabilize in the next couple of years, as they are expected to, then their expanded pipeline could set them up for a return to growth in the future. Not to mention that they also pay a pretty nice dividend that currently yields close to 4% with a reasonable payout ratio of 37%. So I know that this was supposed to be my medium risk stock, but this one might be a little bit on the higher risk kind of range. And because I already have exposure to the biopharmaceutical market with AbbVie, and that also has a ton of risk associated with it as well, there's just not a whole lot of reasons for me to invest in Gilead at this time. But the good news is that a lot of this negativity is being priced into the stock right now, which leaves a lot of potential upside in the future. And at the very least, I think that Gilead is definitely a company and a stock worth tracking. And hey, at least they're making moves, they're expanding their pipeline, and they still have the funds to keep doing that even more in the future, whereas like a company like AbbVie has a really horrible balance sheet, so they're very limited to what they can do. But they also have a lot of cash flow. So anyway, there's kind of trade-offs with each of them. But again, Gilead, definitely a stock that I think is worth watching at the very least. Okay, and that brings us to stock number 3. And in my opinion, this one is very low risk if you're thinking long term, and that's just my opinion, but this is a company that I am very bullish on, and this is a stock that I've really been wanting to buy very recently, and I'm actually thinking about buying it soon. It's definitely like at the top of, like somewhere at the top of my list in terms of new stocks that I'm thinking about buying, and I really do believe that I will own this stock in the near future. And that company is, of course, Google, ticker symbol GOOGL. And the cool thing about Google is that they are a very dominant company, yet they're still growing at a very nice rate, and their stock recently took a little bit of a hit. So let's go ahead and take a look at this one. Okay, so taking a look at the stock, we can see that they've definitely had some solid performance over the past 5 years, climbing by close to 90% over that time. But most recently, the stock has been stuck in this kind of channel of $1,000 to around $1,200 to $1,300 per share, but currently they're actually down about 13% from their 52-week high and currently sit just below the midpoint of that 52-week range. And honestly, with a company like Google, I think anywhere lower than the midpoint of their 52-week range is probably a great buying opportunity, because I have almost no doubt in my mind that this is a stock that will trade much higher over the long term. In any case, this now puts their stock trading for just a little higher price than the sector that they operate in. In fact, their forward PE and PEG ratios are just barely higher than the sector medians, and this is Google that we're talking about. They control over 92% of the global search market with Google Search, with nobody even coming close, while Microsoft's Bing is barely staying alive in second place at 2.5%. They control over 63% of the internet browser market with Google Chrome, while Apple's Safari barely competes at 15%. They control over 76% 26% of the mobile smartphone operating system market with Android, while Apple's iOS barely competes at 22%. And even if you include personal computers, Google still beats Microsoft at 39%, while Windows takes second place at 35%, and they even have one of the biggest presences in social media, with their YouTube platform doing well above 2 billion users every single month. All of this dominance across all of these different markets has led to Google also dominating the digital advertising market with over 38% market share last year, which is a market that is expected to be worth almost $130 billion this year just in the United States alone, and over $333 billion globally, which continues to grow and get even bigger and bigger well into the future. So why then is the stock down? Well, their last quarter wasn't as great as Wall Street was expecting, and new reports have been coming out lately about an antitrust probe from the United States Justice Department, which seems to be a common theme for Google, who's paid several fines before because of anti-competitive practices. But even when they paid $2.7 billion in 2017, $5 billion last year, and another $1.7 billion this year, they just counted them as operating expenses and continue to report billions of dollars on the bottom line. In fact, their sales have been soaring, climbing from $75 billion in 2015 to $137 billion in 2018, and are expected to continue growing to $188 billion in 2020. That's growth rates of around 20% each year, and it doesn't just stop there, as their profits have been equally impressive, reaching a new record high last year of about $31 billion, which was up by over 130% year over year. Sure, that was a record year coming off of a down year, but they're still expected to continue growing in the future, even with these already enormous profits, with EPS growth of 4% this year, 17% next year, and an average of 12.5% over the next 5 years. And most of that is just based on what Google is showing so far, but they have other parts of their business that have a ton of uncertainty surrounding them, but they also have massive potential to break out as huge catalysts for growth in the future. This includes things like their Waymo business that is focused on autonomous driving, which is a market that could be worth billions, if not trillions of dollars in the distant future, but even in the short term, it should be growing at a compound annual growth rate of at least 20% through the next decade. And speaking of autonomous driving, Google is also a huge play on artificial intelligence, given not just Waymo, but also their smart digital assistant called Google Assistant, and they even have a few subsidiary companies that do a ton of artificial intelligence work in healthcare like Calico, DeepMind, and Verily, which work to improve healthcare data, help to predict possible illnesses, help diagnose diseases, perform robotic surgeries, and even try to figure out ways of extending human lives. So even if the antitrust probes go very poorly for Google, I just think that they'll adjust their business, they'll make some changes, they'll pay some fines, and they'll move on like they always do. That's just my opinion, of course, but looking out into the long term, into the future, I think that any dips along the road for Google will just be kind of speed bumps, and I think that they will ultimately be proven to be buying opportunities for the long term. And this is definitely a stock that I really believe in. I'm actively tracking it, and it is definitely one that I'm interested in buying at some point in the near future. But anyway, thank you guys so much for watching. I hope that you guys enjoyed the video. Again, let me know if you enjoyed this kind of format of high risk, medium risk, and low risk. And please consider hitting the like button. It really helps the channel out a lot as well. And I guess that's it. I'll catch you guys in the next one. Leave your thoughts and comments down below. I'll see you later. Take care. Bye-bye.